Is everything in the market expensive right now? You may have heard in listening to financial media or the news that all markets around the world are really expensive, and therefore we can expect lower returns going forward for stocks. And this conversation has started to pick up steam, especially in the past several months. I actually heard a report this morning on CNBC where there was a gentleman talking about how he expects, the returns for the S&P 500 to be lower, especially in the short term because markets are so expensive or relatively expensive based on kind of their historical levels where they have traded historically. And I think that there might be some truth in that there are certain segments of the market that are trading very expensively right now, but there are also certain types of stocks that are not trading as expensively. And this may be something to consider as you're deciding how to allocate your investments. There are areas of the market that are not, super expensive right now that might be able to give you higher expected returns. And so I thought the best way to illustrate that is with the chart. So I'm going to share my screen with you here. And this chart is from Dimensional Fund Advisors, and it was shown in a presentation that I attended earlier this year. And what you're looking at, this is two types of stocks in the United States. One is growth stocks. Growth stocks are relatively expensive stocks. And what that means is that their stock price divided by their asset value is a high number. So growth stocks in the United States, when you consider growth stocks, think about large tech companies over the past 10 years. So large cap growth stocks in the United States have shot out every light in the joint for the past 10 years. They've been fantastic. If you hold a market cap weighted index fund or the S&P 500 in your portfolio, you have done really well because that particular index is very heavily weighted in large, expensive stocks. On the other hand, you can also purchase, or the other line here on this chart is US value stocks or relatively cheap stocks. So if you take the price of that company's stock or a value company or a value stock, if it was considered a value stock, the price of that stock divided by its underlying asset value, if that's a lower number, that's considered a value stock. And value stocks have done okay over the past 10 years. It's not that they've done badly. It's just that relative to large cap growth stocks, they haven't done as well. And the chart here that I'm showing you, I want to be very clear. This is not a price chart. This is showing you the relative cost or the relative price of growth stocks compared to value stocks. And the big takeaway here is that, yes, there's certain segments of the market, particularly growth stocks, that are very, very expensive relative to history. So the price to book ratio of US growth stocks, you can see it kind of bumps around here at a reasonably stable level. But then once we kind of get into 1997 up until 2000, the spread between valuations of growth stocks and value stocks really blew out. And what happened in 2000? That was the tech bubble. So very expensive stocks kind of ran away out of control. And then that bubble popped and they lost their value very, very quickly. And then, I'm not calling a bubble here because you can't call bubbles in advance, but the prices of the most expensive stocks in the United States are at very, very high levels. Now, this chart ends at the end of 2021, so there's certainly some data that kind of falls into this, but the spread between very, very expensive stocks and very, very cheap stocks is as wide as it's ever been. So what does that mean? That means that, yes, there are stocks in the US market or a subsegment of stocks in the US market that are very expensive, but there's also a humongous chunk of stocks in the US market that are relatively cheap and that are actually really good value right now. And so I thought a good augment to this chart is this chart below from JP Morgan Chase. And they put together this guide to the market that they keep updated. It's a fantastic resource. I'll link to it in the show notes below. But what you can see here, and I'm going to move around this chart a bit, and I'm going to use my indicator to kind of help you follow along. But over the past 10 years, as you can see, large cap stocks, the annual performance of large cap stocks, specifically large cap growth stocks, has been very, very high. Down here in the bottom, small cap, it's been okay, but not as good as large cap growth. But let's see what's happened since the pandemic hit, specifically since the lows in 2020. Wow, small cap value stocks have done fantastic. Now, growth stocks and large cap stocks as a whole unit have done well as well, but small cap value has done really, really well. So things are starting to change. They're starting to turn around. Now, back to where we began, is everything expensive? Is everything really pricey right now? And the answer is, well, there's certain parts of the market that are very expensive right now. So based on current price earnings multiples, which is another valuation ratio, large cap growth stocks are trading at 144%. The prices are 144% of their 20-year average. So they're trading relatively high based on their 20-year average expensiveness metric, which we're going to call price earnings ratio. But there's still a lot of really good opportunities, or there's a subsegment of the US market that is still relatively cheap, and that is small cap value, even mid cap value. And I will argue that large cap value, even though it's trading slightly above its 20-year average, it's not at levels that you would consider it to be mega expensive or super dangerous levels of price relative to its underlying fundamentals. So that's it for the slides. But I just wanted to show you that there's a lot of things out there talk about, hey, everything's expensive right now. There's really no way to find stocks or investments that have the promise of higher expected returns going forward. And valuation is not anything you can time. And when I showed that first chart with the spread between growth and value, whenever I show that to somebody, I say, I would tell you the same thing this year that I would have told you 2 years ago or 3 years ago, that value is cheap relative to growth, but growth continued to the multiples of growth continue to expand. So it's hard to time it. It can continue to spread, and that spread can continue to widen. But if you're looking at your investments over a really long time horizon, if the goal of investing specifically in stocks is to purchase assets that are cheap, relatively cheap as a group, and hope that they will realize higher future returns, historically, that's been a really good way to invest. And I think that opportunity is presenting itself right now for people that are predominantly or exclusively in just simple large cap index fund type portfolios. Even a lot of the broad, Canadian and US actively managed fund portfolios that I see are very heavily weighted in that large cap space, which we just covered, are very expensive right now. You can find funds and passively traded vehicles that will tilt or will have a lot more exposure to small cap, and specifically small cap value, which are still, in my opinion, priced at fairly reasonable levels as a group, and I think provide an opportunity going forward. So I hope that you found this video helpful and interesting. If you like it, give it a thumbs up, leave your questions and comments below, and I will speak with you soon. Take care.